Hi, everybody. How's everyone doing today? Ren, Hugo, how's it going? Let's have a good week. So, I have a question for you guys. Okay. So, we all know that it was a shocker number on Friday. What was the most unreported and significant move that occurred Friday? Hello, Paul. Scott, how are you? Didier? Well, was it the S&Ps going to new highs or the dollar getting hammered? What was it? VIX, that kind of goes along with the market blasting off. That's not it. Gold had a great day. That's not it. Crypto's not it. And just in my opinion, for many, this could be it. Oh, you cheater.
I know. Is it lean hogs? I'm kidding. Good morning.
Anyway, Scott's got it. Okay, so real weak number. And look at what yields did on Friday. So they went on the number, real weak number, right? But look at what they did. No one's talking about the reversal in yields off a real weak number. Scott, you're a cheater. You knew it from Saturday. Okay, so that I think was the biggest move that no one's talking about. All right, so what's the implication of this? A lot of people say it's all about yields. Well, not everything happens immediately on moves, correlations. Sometimes there could be a disconnect. And I'm saying it's significant. So, it's up to you to decide what outside markets are going to be affected by, if it's correct and we're going up to new highs in yields. So there's no audio on YouTube. Okay. Hi, Monica. Okay. So, some of the things you're saying, yeah, maybe, eventually it can have an impact on metals, maybe the dollar, maybe tech stocks. I mean, tech stocks are showing it today, right? I mean, NASDAQ's down 61 with the S&Ps up. Hello, Raj. Okay, so I'm sure our tech knows about there's no sound on YouTube this morning. Okay.
Yeah, we told them, let's see if he can get it fixed.
Yeah, thanks, Stel. So that's really the significant thing that I see. Okay. Most people it goes unnoticed. I do think that we're going to see new highs in yields, and we'll see what other impact it has on related correlated markets. But the simplest thing to do is just a short notes, short the 10-year note. Oh, thank you, Amira. I hope things calm down there in Jerusalem, Paul. So, the purest play is to, short bonds. Okay, short notes, buy derivatives or ETFs that take advantage of higher rates. And I think we're going to, and Greg had talked about this last week too, that this looked like a 4 and we were going to get one more low. Definitely would have been tough to sit through the initial response, right? I mean, this was, one hell of a spike. And, I could be wrong, but I'm not wrong unless we take out Friday's highs. So if this is going to be the case and we're going to get a rally in yields to new highs, I'll be paying attention to all the markets that you guys mentioned. Nothing that, one thing that you didn't mention is the yen. Okay. So as weak as the dollar has been, can you imagine how weak the yen is? If the yen is weak compared to the dollar, which when USD Japanese yen, I don't know anything about that. I think the pure play is short notes. Why not just do, trade the instrument? So I don't know if it's going to show up in inflation. Yeah, there's futures, Paul, in bonds and notes. Okay, so the yen would be part of the conclusion. And it's interesting, last week on Friday, look at what the yen held. So I know there are a lot of people bearish yen, and we could go to 107. This could be something like one more flush, but I think even if we retest 61.8, if you want to be long the dollar against anything, I think it would be it could be risk on. But the risk on is definitely in the S&P. So if the S&Ps have the juice to travel up towards 4,300, here's your big number that I talked about in NASDAQ, 13.8. Okay, it's almost like they're two different markets, doesn't it look like that? Kind of like how the euro looks compared to the pound today. And it's amazing to me that cable got this kind of pop just on, I believe I read that, they've taken the COVID down from a 4 to 3. So I think that's the reason behind the strength in cable. You actually had this kind of ghost trade up here on Sunday night's opening, and then it traded here. So we're also at 78.6 here on cable. So should probably make a new high. This is a confirmed high. Okay, the local elections may be part of it. Okay, I think it's mainly COVID news. Maybe it's, it is election results.
But
Okay.
that's odd, because I thought the kind of nationalists won in the Scottish election, and
Oh yeah.
they've said they're going to have another, or they're probably aiming for another referendum. So I wouldn't think that's positive for the pound. But anyway,
Okay.
I don't know.
Well, okay, yeah, the vote. So, and yeah, that vote in Scotland, I forgot about. Okay, so, and the nationalists winning, that that's not if they won, why did they decide to stay?
Well, no, if they're going to leave, they're going to have a referendum. But that's
I see. Okay.
Yeah, that's the party that said basically they're most vocal about having a referendum. I think that's what the market may have been fearing, but now that it happened, sterling's rallying. So if anybody can help me, that would be nice.
Okay, buddy. So yeah, I mean, big move in euro pound. I actually thought that we were gonna, maybe clean out stops here, but it's looking pretty negative again, isn't it? So maybe we're gonna get a new low here in euro pound, and this was it for the rally. We'll see. Pretty wild markets. And oil, you had the news about the pipeline, and the thing is it gonna, how long is it gonna last? How serious could it become? When I look at crude, it wouldn't surprise me for another high, right? You have a 1, you have a 2, it looks incomplete to me. We should get another rally. Okay. So those are some of the things I see, and I still believe that if yields are headed higher, this is a big deal. Okay. So we'll see what happens. We could pause and fill out this candle for a few days, which, will kind of make people forget about this. Okay. If it goes back there. Okay, DJ. Feb 2020, what was that? 82? 84? 83. So right in the middle there. Okay. So if anything, Friday should teach you a lesson not to hold positions into red numbers. And we've had a couple of examples of just bloodbaths based upon it. A week or so ago was BOC, Bank of Canada, and this employment report. you know, uh, Unless guessed right. Not many people thought we were going to have a number like that. But I guess if you were bearish a dollar and you had a lead, you feel like a genius, but it could have gone the other way too. So avoid these red events. If there's, anything to be learned from that is you never know. It's really not trading, it's roulette. So um, that's a very important lesson to learn. Be flat into this stuff. Okay. Um, that's about all I have for now. Should be an interesting week, but keep an eye on yields and let's see what kind of reaction we have in some of the other markets that won't like higher yields. Okay. So Blake, how are you? I hope you had a good weekend. Hope you have a great week coming up.
Hey, good morning, Coach. How are you?
Yeah, good. I saw your 5-minute. Jim sent me your little snippet on the interview you did with him Friday, and it seems like Jim is thinking the same way. You guys can find a nice interview by Jim on Traders Summit.
I'll put the link on the chat box.
Yeah, and he thinks it's kind of a head fake and that there may have been technical reasons for the big miss.
He does, and it was nice to interview him. He's one of those guys that I believe more people should really know about. He's got the full picture here, and I think he's just a wealth of knowledge. So it's been great. How long have you known him?
Gosh, 90s.
Really?
Wow. Early 90s.
Yeah, he's
right
a smart guy. I like him. He's like, and not because of his age, but because of his demeanor. He's like your nice grandpa, like the nicest guy you've ever met. That.
Yeah, I knew him, but when we both didn't look like grandpas. And in fact, we were both used to be before CNBC. There was a thing called the Financial News Network when they were in Santa Monica before they went to New York and became, NBC bought them out. And that's how we got to know each other. I was spending summers out in Carlsbad and he was in California. We met at a bar, at the Sandbar, and we've been buddies ever since. So
at the Sandbar, you met him at the Sandbar?
Yeah, we met for a beer there. Yeah,
well,
the Sandbar in Carlsbad. Yeah.
Yeah, I love the Sandbar. Gosh,
it's not there anymore. They turned
they move it down south a little bit, right?
They didn't move it. I think they just sold out. It's changed hands so many times.
What I was thinking. It was the Sandbar that's down there in
Pacific Beach.
Pacific Beach, yeah. It's like that's like one of the only last bars that are actually on the sand. They don't happen that often anymore.
Yeah, I know.
Anyway, that's neither here nor there.
Yeah. Okay.
I miss California.
So, how do you handle Friday's surprise, buddy?
Good. I did the trader battle, and I did it with against Chris Pulliver, which some of you might have remembered him. If you go to Trader Summit and you go to the last event that we did, so here's the event archive. Some of you might remember him.
I remember him.
Yeah, this gentleman right here from Market Traders Institute, and it was him and I matched up against that we did the trader battle, and I'll tell you, it was a non-farm payroll, but it was really easy to read. So hopefully you guys did well. And the reason why I say it's easy to read, because it was like, okay, that number's weak. I told you guys the day before what I was going to do. And I told everybody, I'm like, if it's a weak number, we're buying, risk, and we're going to, sell dollars. I mean, it's very simple. It was a very simple plan. That data was out. It was so weak. I mean, that was below the lowest expectations of any bank. And I forget who the low end was like at 800,000 jobs. What do we create? Like 260,000 jobs. I mean, something ridiculous. And so that number was so weak that the dollar, obviously weakened as risk appetite rose. I mean, so it was a real easy, trade. And so the position I took was long Aussies. And I figured we were going here to 78.50, which we did by Friday. By the end of the day, we actually hit, my target. But yeah, I figured the Aussie was going to squeeze right past here because everybody's short. So, and I really wonder how far the Aussie is going to go now. I mean, stocks are going to have to turn in order for the Aussie to turn, but I thought it was a very easy read and by the way, if you guys want to see exactly how I reacted during the trader battle, shoot, I have the video somewhere. I don't know if Stelios and Steve posted it here. No, I don't think they posted it here. I'll have to.
No, I don't have the video actually.
Where it is. I'll tell you where it is. Hold on. It was. Let me see. 6 things to. Oh, you know what? I did a YouTube video on over the weekend on the 6 things that you should know before trading an economic event. And let me see if I can find that for you guys, because it's the link is in here. So I'm going to, and it's one you should probably watch anyway. Just for your, oh, here it is. This is let me just put the link. I'm going to put the link in the description of what we're doing here. So this way you guys have it. So just bear with me, guys. I'm just getting it for you. Here's the chat box. Here it is. But it's in the description of this link. Okay, so here's the video. So if this video right here, it's, well, I'll just put it in the link so you guys can figure it out. Anyway, that will give you an overview of how what I was doing really through the jobs, or through the jobs report. And like I said, it was a pretty easy read. And I mean, I had it pre-planned out for the last couple of days. I mean, it couldn't have, what would have made it really difficult, Dale, is if the number was in line. That would have been way more challenging, right? But when you have a number way outside, thank you very much, Amir. Amir just posted it in the chat room. If we had a number that was, more in line with expectations, it would have been a more difficult read. But because it was so, below expectations, it was, pretty easy to figure out.
It was a shocker.
It was a shocker. And, the thing I pointed out during the week ahead video, and the thing that I, have to think about right now is look at the Fed Chairman Powell and look at how dovish he's been. And you have to admit that he's been dovish probably for a reason. And, they're obviously, his big concern has been employment, and that's, and until we can see jobs really come back and we can make up some of that lost ground, he's going to continue to be dovish. So that's why you're seeing, stocks continue to rally to all-time highs. The dollar continues to get hit, and I don't foresee this stopping. Like, I don't know what's going to really stop this move now. And then you have, like, you look at these cryptocurrencies. I mean, look at Ethereum. It's at $4,000 this morning. Definitely a value play right here. I'm joking. That was a joke. I know some of you are like, what? But look at this thing, how it exploded when we went outside of that channel, this was 2 weeks ago when we were probing this like 2,800 level. It was 2 weeks ago, because I remember mentioning it on a Sunday night during the week ahead video, saying, hey guys, watch the Ethereum market. It's popping out of this channel. I had no idea we were going to make it this far. I thought we were going to just reach up towards 3,000 and reverse. I mean, it's gained, I mean, this thing's gained another, since then, it's gained another 50% in value, basically 40 some odd percent in value since 2 weeks ago. It's amazing. So you gotta, you know, when you have rallies like this, and by the way, my 14-year-old son and all of his friends are talking about cryptocurrency. Just so you guys know. What's that?
Of course they are.
Yeah, I mean, they're, you know, and it's funny when you have like, I don't say it's funny. It's just, it's amazing when this is the conversation that was at my house yesterday. Is Mother's Day, and my sister and her husband and nephew and my kids, and we had our neighbors over. They're our bubble, you know, our COVID bubble, if you will. But their kids were over, and then they're on FaceTime with like other kids, and they're like, why would I pay $18,000? No, I'm sorry, $20,000 a year in state for Arizona State University, because my kids are going to be going to college here soon. You know, why would I pay, you know, $20,000 a year when I can just, you know, trade and make money? And I was like, oh boy. Oh boy.
It depends. If he intends to study economics, it's much better if he saves the money indeed.
Yeah, maybe, I guess, you know, but the thing is I mean, we're talking about in-state colleges, meaning in Arizona State University is, you know, I went there for a year and a half, and it's nothing, you know, exciting. And I'll tell you, for $80,000 to get your degree in state.
Yeah, it's pretty crazy.
It's crazy. It's Arizona State University. This is not Harvard.
That happens, guys, to any market that the government interferes. When did education?
Student loans, yeah.
Exactly. When did education become much more expensive, and the trend of price increases started becoming exponential? When the government started guaranteeing the loans, because then universities were like, oh, you know, there is a financial backer there. I mean, you know, we can charge more than we need. We can just, you know, start competing on like, you know, how nice our basketball ground is, and you know what facilities we have. So,
but they've had this program, Steve, for a long time. I had federal student loans, and you know how long ago that must have been for college. Right.
Oh yeah, it started actually slowly because exactly. It started with the Vietnam War. Yes.
Okay.
So hey, really quick. I'm sorry. I know I got us off topic. But what I wanted to point out really fast is some of these what the dollar did on Friday. You have to take a look around at what it did like against so many currencies. Like here's the cable. I just exited the pound as we hit 141 from over the weekend. I was long this on Friday. Actually, after the non-farm payroll, going back into the chat room on Friday, I said, hey, I'm going to buy some of this sterling because we're breaking out of this triangle. We were literally trading right here at 139.50. And look where we're at right now. I mean, I know there's you know, some news about, you know, there's some political news that's surrounding the sterling. The fact of the matter is we broke out of this triangle that was consolidating for the last week and a half, and we talked a lot about this last week about this consolidation. So it shouldn't be any surprise that when we extend out of there, that it's pretty explosive. Now I'm going to point something out really quick with the sterling as we get towards the 141.40, because some people in our chat room are like, well, where do we short it? I think you got to be real careful with longs up here. And if you take this high point, and then you find this double bottom right here, which by the way, the double bottom, you know, does point further, just so you guys know. You know, the double bottom will take us down to, you know, 141.70 roughly. But I want to point this out. You know, we are also at the 78% retracement here. And so this whole area, in my opinion, between where we're at currently, you know, to the 141.80, roughly somewhere around here. So again, anywhere within this price 60 pip range, you guys got to be really careful with longs, because look at how overbought the 4-hour relative strength is, and knowing what I just told you, double bottom completion, okay, overextended relative strength intraday, 78% retracement, 161% extension. There's an 88% retracement just a little further up. Those are basically the two last fib levels that you've got really to deal with. Just, I think this is a whole area of resistance that we're coming into. And so if you are long the sterling, just be aware of that. You know, I'm just, this is the price that I'm going to be like real. I mean, I already got out. I got out at 141 this morning. But if you guys are looking for counter trend moves, or if you guys are just wanting to, you know, take some profits up here, I think you should be keenly aware of where we're at right now. Especially it's Monday. We might get a little selling today, a little bit of profit taking today, but you know, if we get like a turnaround Tuesday where risk goes back up again, then you might see one of these, like, you know, pull back a little bit, and then you know, you can get long for continuation moves, you know, going into later into the week. Anyway, sorry, Steve Stelios, I just wanted to mention that because, you know, we've had such an extended move over the weekend. You know, you gotta be cognizant.
You know me. On the other hand, I just refuse to fade dollar and equities. I mean,
no.
I wouldn't be buying it.
Of
course, I wouldn't be buying it. Of course. I mean, it's already extended for the day. I mean,
yeah, you want to try to buy a pullback or maybe sell rallies in the.
Yeah, but you know, I it's been so long since the last time I actually found that, you know, remotely a reason that I would want to be even short term, you know, long the dollar or short equities, and unfortunately nothing has changed. So, you know, the two-way volatility type of trading remains dead and buried.
You know, and here's the thing. So, you know, I had that interview with Jim over the week, or on Friday, which hopefully you guys can go watch that video on Trader Summit. It's right here, guys. It's right here. This video right here. You know, this interview. Watch it, and he's like, well, I think this is an anomaly. You know, this is you know, the Fed chairman's not going to change his tune based on the data. The problem with that thought process is near term is we don't have jobs data for another month. You know what I'm saying? So the dollar weakness that we're seeing right now, I'm not sure I'd want to be on the other side of it more than intraday. Unless, you know, next jobs data ends up being, you know, a really big bounce back, then I'll feel a little bit better about being long dollars. Anyway, just some
you know,
there.
You know, I agree with him, but not only for jobs data. If you remember, I've kept saying that the Fed will not even react.
Wait, Steve, are you eating food on a webinar?
Yeah, why not?
Are you talking with your mouth full?
A little bit of bread.
Did your mom never teach you anything?
Yeah, come on. This is family, you know, just us and a few hundred people.
Typical Greek. All right, go ahead. Go ahead.
So you know, I agree with Jim, and I've said the same about inflation data. I don't think the Fed will react even to inflation data, simply because if they acknowledge there is an issue, then they have to acknowledge they need to do something about it. But are they actually willing to derail the quote unquote economic recovery? No, they're not. So they will keep acknowledging only the data that are that are giving them a reason to remain dovish, and completely ignore the data that would force them to be hawkish. And I think this is going to go on for, you know, quite a period of time. I don't think we're nowhere near some kind of central bank, you know, turn of, you know, policy.
So, sorry guys, I was just looking. This is probably a good setup for you all. Something that I'd be thinking of was like if you can get a 140.30 entry. Sorry, I just want to go just revisit the sterling really quick, and looking for a move back up to like the 142, maybe even further. You know, we might actually extend this all the way out to like 143.50. So, you know, do something like this where you know your risk is very limited. You might be risking close to 50 pips. You know, like let's say you know trade 100,000 in currency, you're risking that's $327 or in sterling. So you're talking about a $500 risk, you know, to make probably closer to $3,000. I mean, that's not a bad risk reward for, you know, a dip back to the breakout point. Anyway, that's just some, I wanted
Indeed.
to give you guys that food for thought. All right.
The question is, are we going to see a pullback?
Are we going to get back down there? I know.
Yeah,
you know,
that's a question.
That's always the question is, do you think
Yeah.
and again, this has probably more to do with equities and let's also not forget, and I know Dale, you've got to take over here in just 1 second. If you look at like gold and silver, you know, gold is the double bottom completion actually happened on Friday, but notice how we're stalling up here. So let's imagine for a second, gold, you know, is complete. That double bottom is complete, and we pull back a little bit in gold. This will allow for a move. This will allow for this move to happen, in my opinion. You know, you'll see a bounce back in the dollar if gold and silver actually pull back a little bit. I'm not saying they're going to. I'm just saying if they do, because they have stalled. They've stalled since Friday. Anyway, hey guys and gals, I need to mention before I go, if you haven't visited our webinar sponsor, please do so. Pepperstone Securities, they are our webinar sponsor. They make sure that we could do these free webinars for you guys. If you live outside the US or Canada, please open your account here, because if you do, you could get up to 4 months free of ForexAnalytix. If you live in the US and Canada, contact Forest Park FX so they can make sure that you're getting cashback rebates, because if you are not getting cash back on your trades, I don't know why you're not.
You're just giving that money away, as simple as that.
You are. Yeah. So anyway, all right, Dale.
Well, you do a lot of that, don't you? You're a very generous guy, Steve.
Oh, Steve does,
gifting
yeah.
my money away, not to brokers. Thank you.
Oh, okay. Yeah.
I don't think they really need it. I mean, they make quite a lot. I think they can survive with somewhat less.
Poor brokers. Go churn your account.
Yeah.
All right. So thank you, Blake. We have
guys.
Stephen Clapham with us. Stephen, welcome back to Face. How are you? Waiting to hear your voice. I have made you a panelist.
Hey Dale, sorry about that. I was muted. So I'm doing well, and I've come in the right day because you're talking about sterling.
Okay, right. Okay, is sterling behind your balance sheet?
Well, I'll tell you what, my balance sheet didn't have much sterling for quite a long while, but I've closed almost all my sterling shorts, and I can see what the guys were talking about. You know, overbought intraday, but you know, you don't want to base your reference on 120 or 125, because sterling, you know, 150, 160 is kind of like the right relationship against the dollar. And you know, when I was earning in dollars, it was $2 to the pound, which killed me.
I remember.
But I'll tell you what, you know, at 140, sterling still looks quite cheap to me. And
there's people talking $2, Stephen.
Well,
longer term.
I don't think it's going back to $2. I'll tell you, if it goes to $2, I'm going to move to America. But
okay, that's really a desperate
If
move.
it goes to $2, probably it's going to be the era that you won't want to move to America.
Well, I don't know. I like America, but
yeah, me too. But if it goes to $2, there's going to be a very good reason for it, and I don't think things in America are going to be very rosy.
Well, you say that, but it was $2 in pound was $2 in 2006, 7. You know, it's not that long ago, 15 years ago, and America was doing pretty well then. So, you know,
good counterpoint, Stephen.
Different circumstances, and the reason is going to be different for it to go to $2.
Well, it might
than
be.
It was back then.
It might be this time, but I think you don't want to be short sterling anymore, because we've got, compared with the rest of Europe, we're doing much better on COVID. So the vaccination program is way ahead of the rest of Europe. We've done very badly. So the economy was very badly hit by COVID, but we should bounce back out of it much more rapidly. And relative to the rest of Europe, we're much more tech oriented. So obviously the quoted markets aren't as tech rich as the United States, but the economy is quite tech rich. You know, there's quite a lot of tech activity goes on in the UK, particularly in London. So, you know, I wouldn't write off the UK economy. I think we're set up, we've got a good setup. And although you might not want to buy sterling today, I wouldn't rule out buying sterling medium term.
What do you think about, do you follow Euro Pound, Stephen? I know you're a stock picker, and we're talking Forex here. Euro Pound is, you know, sharply lower today. So has cable become kind of like safe haven for people in Europe? Do you think the Europeans are dumping euros and buying cable?
Well, it's possible. I mean, I don't know what's happened today, Dale, so I don't want to particularly comment on
well,
that, but...
for example, the euro's up a few pips with cable up over 100. So
well, the thing is that I think you've got to be very cautious about the euro, because the euro is a very artificial construct, and there's all sorts of strains and pressures we've seen across Europe in the economies. Now, look, they're all committed to maintaining the euro, but will Italy, will Greece, will they manage to claw themselves out of their current predicament? And I think, you know, at some point, you know, Germans retire at 65, and they look at themselves bailing out Greece, where they retire at 60. And, you know, if you were a German voter, you'd have to ask yourself, what is this all about? You know, I've got no relationship to these Greek people other than the fact that we're sharing the currency. And I would be quite upset about it. And you've got to remember also that the tone at the top is going to change in Germany, because Angela Merkel is going to retire, and we're going to have a new leader. We're going to have
right-wing nationalists.
I hope not. I can't imagine that happening in Germany. I really can't. But you know,
well, it happened you know, a century ago.
It happened a century ago, but you know, it was so awful that hopefully, you know, memories are still fresh.
Yeah.
But you know, we're going to have a new leader in Germany. I'm not an expert on German politics, but there's various factions bidding, and you know, these European governments tend to be coalition governments. So it tends to be, you know, in order to get your coalition in power, you've got to side with a more marginal faction, and they therefore can hold an undue power relative to their size. And you know, the Greens have been doing very, very well. Interestingly, the Greens got 7% of the vote in the London mayoral election this last weekend, which, I mean, that really stunned me. So euro, I would be very careful about, because I just think...
What did the Greens, Stephen, stand for? What's their political platform?
The Greens are environmental party.
That's
so
what I thought.
They're Save the Planet.
Yeah, and tree huggers.
They're the tree huggers. But you know what? We'll all be tree huggers in a few years, because
we're going to miss them, or what?
Well, we're missing the trees. I think you know, this is a movement which is far more pronounced in Europe than it is.
Every time I hug a tree, though, I get scratched up by the bark.
Yeah, but you probably drive a pickup truck and have a house with air conditioning and and pollute the planet. Whereas we in Europe, we're trying to save the planet, and there's a massive swing going on. This is partly demographics as well. Remember, because you've got more younger people voting, and the more younger people you have, the more environmentally conscious they are, and the more likely they are to vote green. So the bottom line, Dale, you didn't invite me on to talk about politics, but I think the bottom line is that buy sterling medium term, but be careful of the euro, because the euro is one of these things that can come back to bite you because something unexpected can happen, and it's just not a normal currency. So I think you've just got to be slightly careful about it.
What about the I mean, you've turned this into a currency discussion. What do you think about some of the commodity currencies like the Australian dollar?
I'm not an expert.
Not familiar? Okay. Let's get back to your wheelhouse then, behind the balance sheet and the book you wrote, and we've had ongoing, continuing bull markets across the world, just in different degrees. I'm not sure. I haven't looked at the London market, the FTSE, in a while. I know it was underperforming US. What are you seeing out there, and what do you think are some good picks? Could some green stocks be the way to go, since people are, there's going to be a lot of money spent here in the US if President Biden gets his multi-trillion-dollar package passed? What's on your radar today?
Well, sure.
Steve?
I mean, I think, obviously the strength of sterling is weighing slightly on the London market, because a lot of our big stocks tend to be overseas earners, and all the biggest stocks have got very little of their business in the UK. So they get hit by the translations. As the pound gets stronger,
right,
they find it harder to grow their earnings and their cash flows.
Right.
But I think there's a huge amount of small value companies in the UK which are sterling denominated, which are dealing domestically, which are doing extremely well. And this is not a recommendation to buy it today, but stocks like Next. So Next is a UK retailer, but it's got like
NEXT.
NEXT, yeah.
It's one of my favorite words, most important word for investors and traders. Because we all dwell in the past sometimes. We look back and say would have, could have, should have, and instead of wasting that energy, you should be saying next. Just like a great athlete who makes a blunder on the field, he doesn't sit there and commiserate it and talk to his teammates about it. He just it's good to have a short memory and move on.
Yeah. Well, Next is an interesting company because it's not just an apparel retailer. So it sells men's and women's clothes, but its background was it used to have a catalog, and it sold a lot of its products on credit through the catalog. And that catalog, the sales have translated into online sales. So it now does a lot of online sales, but it makes a huge margin when it sells on credit. And it does that.
Do you want to share your screen, Stephen? I mean, I have your logo up there. You want to just talk, or was there anything you wanted to visually show people?
I don't have anything on Next.
All right, so go ahead.
Because I didn't know what we were going to talk about. But let me just tell you a bit more about it. That Next is interesting because it's got a very good online business. And it's now doing a sort of mini Amazon. It's actually offering its logistics capacity to its competitors. So it's not just a retailer, it's also a tech business in a way. And it's run by Lord Wolfson, who is one of the original family behind Gus, Great Universal Stores, which is Next is a spin out from that. And so Lord Wolfson is one of the original family, and he's been, I think, one of the best FTSE 100 chief executives that we've seen. He's actually a brilliant strategist. And even if you don't want to invest in his company, I would say to you, your listeners, your viewers, really worthwhile going on the Next website, Next PLC, looking at investor relations and reading some of his stuff. In my courses, you know, Dale, I've got an online training school, and when I talk about buybacks, I use the philosophy that Lord Wolfson wrote down in his chief executive's report, I think back in 2012, because he explained the reasons, the strategy behind buybacks, and he did it better than anybody I've ever seen. So Next PLC is very interesting stock. Maybe not necessarily, you know, one that you need to buy right now, right here, because it's had a good run. But generally speaking, that's a symptomatic of the sort of value on offer in the London market, and it's really an interesting market, I think, now, because we're early coming out of COVID. We've had a very bad experience, so we've got a very low base we're coming from, and we've, you know, like you, we've got very loose fiscal policy, very loose monetary policy. So
yeah,
the economy's growing extremely fast. But the worry I've got here, and I think it's probably a worry you probably want to have in America as well, is inflation.
yeah.
I don't know what you're seeing there, Dale, but I'll tell you, my personal experience is that inflation is already very strong here. So I just went for lunch with my wife to the local sort of healthy Japanese, Asian style food place, and the prices, they changed the size of the bowls.
Okay.
So it's like a takeout. It's like a takeout, or you can eat in, but you get it in a plastic container or a cardboard container, and they changed the size of the container, and they put the prices up. So you've got both shrinkflation, what we call shrinkflation, where they reduce what you're buying, and inflation, where they put the prices up.
Yeah, that you're exactly right. Well, a lot of it has to do with what's happening in the commodity markets. You have grain prices, meat prices through the roof. Okay, so it's you know, you've never seen prices like this in grains and meats, at least in my career. There used to be a war chant at the Board of Trade for beans in the teens, and they're way above the teens. So you know, you could just look at almost anything. Corn, same thing. Wheat, same thing. Sugar, same thing. So commodity prices, and it's not all because of supply chain issues. Some of it's supply chain issues. Some of it's just supply.
Yeah.
And a weaker currency. So yeah, we're seeing it here, but we're only seeing just the beginning stages of it. Yeah, haircuts, everything's gone up. So yeah, very different environment than we had a year ago. Very different.
I mean, it's just
without a central bank that I think has either the capability or the willingness to. This is their goal, so they're going to accomplish their goal. For higher inflation in spades, probably be more successful. I think they're already successful, and they don't think they are.
Yeah,
because of their measured moves.
I think it's a real worry, though, because you know, once inflation starts, it's quite difficult to get it out of the system, and you know, they don't want to put up interest rates, and that's traditionally been their principal lever to pull against inflation. So they don't put up interest rates to cool the economy down, then inflation is going to get hold. And yeah, I mean, that's good news.
And that could really only slow down maybe economically sensitive commodities, but you can't print grain to bring down the price of grains, and higher interest rates aren't going to affect yields on crops.
No.
So, you know, there is some, you know, really real inflation, not just monetary inflation, based upon supply demand and the supply of grains and stockpiling by China for years. They've been stockpiling wheat, so they knew this stuff was coming. And, you know, I don't know how you resolve a Super Bowl market in food and how you get it to come down without, you know, really increasing production, which can take quite some time. And, you know, that's more of like getting back to what you were saying, a climate issue.
Yeah.
On growing food.
Absolutely. And you know, it's not just, I mean, it's not just food. I mean, you know, copper. Somebody was asking about copper, and you know, the supply response is going to take quite a long time, right?
Yeah, to find new mines or reopen mines. Yeah, another very long process. So my friend and associate Steve Volge likes anything that has intrinsic value will go up in this environment.
Yeah, I think that's right. And you know, I'm not as big a fan of the energy complex, and in particular, that you know, there's a lot of people like the big oil majors, which are very significant components of the FTSE 100, and I've been very negative on them for 2-3 years more now, and I'm still quite cautious about the big oil companies, because we're seeing so much money being diverted into ESG related funds that those funds are never going to own an oil major. So almost irrespective of what you believe about the energy market, it's just going to be very, very hard for those companies to attract new shareholders. And they've got a huge problem as they try and shift away from their traditional hunting ground of oil and gas, and they're now starting to get into things like wind and solar, and they're paying just ridiculous prices, and they've got, you know, a huge balance sheet to shift, you know. So
yes,
they're going to push the price up of these renewable assets, and they're going to find it very, very difficult to generate a decent economic return. So you've got structural challenges within their business, and you've got the less attractive to the growing pool of shareholder money. So they are kind of like the thing to really avoid. But other commodities, I think, are, you know, it's hard to see what you shouldn't like, especially in this sort of environment where you're getting accelerating economic growth, admittedly coming from a very low base, but also, you know, many areas restriction on supply. So
how about PMs as a hedge? Precious metals. What do you think? Are there miners that you've looked at balance sheets and you like, and is it possible that a lot of the majors will start to look to buy up smaller gold companies and buy their production? Could we have some M&A going on in the mining sector?
Well, I think there will be, and especially as prices rise. I mean, I've been slightly bemused that gold hasn't gone up more. You know, when you look at the cryptocurrencies and you look how strong they've been, you would have expected there just to be some spillover into gold. But of course,
I've heard it's competition to gold.
Well, it is competition to gold, but you think that, you know, one would drag the other up. You know, normally that's what happens. I mean, the people that are buying crypto aren't the traditional gold buyers. But you think it would make older people like me buy more gold, right? Because, you know, you might say, well, I don't really understand Bitcoin, but I understand why people are buying it, because it's a store of value. It's not a fiat currency. So why don't I buy some more gold? Because at least I do understand that. And it's puzzling to me why gold hasn't done better than it has. But obviously the miners are well placed. And, you know, if we do get more inflation, then I think people will turn to precious metals, and so the miners will be in good shape. But I'm not a real, you know, the guy that I look to for the comments on gold is Fred Hickey, the High Tech newsletter, because I think he's a brilliant analyst, and he spends much less time these days talking about the tech sector and much more time talking about gold. And he's very good at spotting the smaller gold companies, which he thinks are going to be targets. So I would listen to him rather than listen to me. That's where I go for my gold advice.
Where do you go for your view on interest rates, the gilt market? Because I know here in the U.S., Paula says he's not even thinking or thinking of raising rates, but you know what? He may not have. But when you look at what rates have done over the past, say 6 months, 8 months, you know, we were down to 0.50 and rates have tripled. And it looks like they can make the 10-year note could make a run for new highs in yields. What's happening there with interest rates in the UK?
Well, I think we just follow you.
I thought we followed you. I was taught early on, I'd watch the FTSE as kind of being leadership, but you know, those are the old days. But you think that that the UK now follows rates? Say, for example, what do you get for 10-year paper in the UK right now?
Well,
you know,
we've got the most I mean, the thing I think that's most extraordinary is how low the difference is between the 10-year and the 30-year, and even
the spread.
Yeah, the spread. And I was talking to a very famous property investor who is, you said, where do I go for this?
Oh my, yeah. Is your real estate market's on fire too, right?
Well, I mean, he's been very, very smart on bonds, and I go to him and I go to Russell Napier, whom you may have heard of, financial historian, who's written a couple of books. And I interviewed Russell for Real Vision a few months ago, and that interview is now up on YouTube. And Russell's, I mean, he's one of these guys that you don't want to listen to what he says and do it today, because you know, he's one of these like brilliant people that are too far ahead of the market.
He sees things before the market recognizes it, and so you can be early with his stuff, but it ends up manifesting. Is that what you're saying?
That's right. Like me. So, you know, I kind of I spend time listening to what he says and trying to figure out, you know, how many years too early he is. He laughs himself about but you know, some of these great thinkers are just, you know, they're brilliant that way, but they're not, you know, they won't make you money in your trades. You need to think about, you know, when you deploy it. And he's got some very radical views about what's going to happen. And he's, you know, he's of the view
a crash in real estate.
Well, he's not predicting any crashes, but he thinks that eventually the government's going to control the allocation of capital. And he looks back to the period post the Second World War. And I think, you know, in many ways, this period today, if you're trying to find a parallel, looking for the parallel in the last 40 years when we've had interest rates go from 15% to zero is the wrong time to look. And what you've got to do is you've got to look back at that period in the late 40s and through the 50s, because that's a much better parallel. And in the late 1940s, the French government had a bureau which allocated capital. And there were, I mean, you think that's mad, but in that interview, he talks about how the US controlled the allocation of capital, and the US had a similar strategy. And, you know, I think that's the thing that we need to worry about. If we get inflation taking control, governments can't put interest rates up. What else are they going to do? And I think that, you know, he thinks that what they're going to do is they're going to control where the capital is allocated. And if that happens, that's a complete disaster for all of us.
For what, people in the markets? It'll shut down the markets?
Well, it won't shut them down, but it will make them, you know, very
non-functional, dysfunctional.
Yeah, dysfunctional and you'll be at the whim of governments. So whether you can, you know, raise capital to grow your business will be down to whether the government says you're allowed to raise equity. I mean, it'll be fine for, you know, those companies which have got strong cash flows and don't need any external capital. But
for the capital formation and new companies and innovation and everything, it's going to be a roadblock.
Well, it'd be horrible. Yeah, I mean, it would
Yeah.
just be it'd just be a disaster. So we've got to hope.
I hope you're right, and he's a decade early.
Oh, yeah, I mean, I'm sure he's years early, but you know, I think we've got to think about that in the back of our minds. That
maybe that's part of the Great Reset. You know, do you hear people talking about this, Stephen? And then we have to wrap it up, and I want to make sure that people know where to find you. What's your concept of the Great Reset? Do you hear that bandied about in the UK?
Yes, but different people have different views on how it happens.
Yeah. Okay. And is it a currency reset?
Well, I mean, people, we just don't know, do we? We know that we're in a very unusual time, and we know that to get out of this will require some change, and we just don't know how.
Right. Okay. So I'm going to show your website, okay, and the book that Stephen wrote, and look at all the great endorsements that Stephen has. And you could get Stephen's book on Amazon, right? And there it is.
In fact, the book just came out on Audible. So if you like listening to books rather than reading them, you can get that now. And my website's behindthebalancesheet.com, and you can find me on Twitter at Steve Clapham. And since I last spoke to you, Dale, I've set up a YouTube channel. It's a YouTube channel, Behind the Balance Sheet, and we've been growing. I mean, I've been posting a new video every single week, and it's been growing really nicely. So I'm really pleased about that. So check out, it's all free, obviously. And
okay. Well, I just want to say I appreciate you coming in. Thank you for your time today, Stephen. And, you know, it's always interesting getting views from outside the U.S. And my goodness, you're a Renaissance man. So you are not only interviewed, but you conduct interviews for Real Vision. So
yeah, well, they liked my interview and said, you know, would you like to have a go yourself? I said, sure.
Okay.
They're stupid enough to let me behind the camera, so to speak, and it's been good. It's been great fun. I've been really enjoying it. And Dale,
it is fun.
It's so kind of you to have me on. Thank you so much. I really appreciate it.
Who better to ask the questions than who has been answering the questions? That's the way I look at it. That's the way I've always seen it. So thank you very much, Stephen, for being with us. And I'll be talking to you down the line. We'll set something up for you to come back.
I really look forward to that. Thank you so much. Have a great day.
All right. That's a wrap, everyone. And we hope that you enjoyed the interview. Everyone have a good week, and you could join the team in 13 minutes to get the morning edge from Blake and look at his bias chart, and the whole team is there contributing. So see you guys tomorrow for Turnaround Tuesday. Don't just count your pips, count your blessings. Adios.